Welcome back to the ProTicker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone. We've landed today in what feels like a fundamentally fragmented global market. We're pulling together insights from a whole range of sources: CNBC, Bloomberg, Yahoo Finance, Reuters.
And if you're looking for one single theme, good luck. It's all conflicting signals.
Exactly. Tech is having this pretty severe confidence shakeup. Central banks are going in wildly different directions.
And here in the U.S., we're about to get this inflation reading that's, well, it's highly anticipated, but it's also deeply messy.
Right, and it could really set the tone for 2026. So our mission today is to give you the shortcut. We're distilling what all these moving parts mean when you actually put them together.
We're not just reading the headlines.
No, we're figuring out the so what.
And it's absolutely critical to connect these dots right now. I mean, what's fascinating is tracing how one single event, something that seems isolated,
Like a funding deal in Silicon Valley.
exactly how that can instantly trigger losses all the way in Tokyo, or how the demand for one specific chip, HBM, can just completely override these bigger concerns about financing.
It's the perfect example. So we've carved out a clear path for this deep dive. First, we're unpacking that surprising AI spending slowdown that hit Wall Street overnight.
And the huge divergence it revealed in the chip sector.
Then, we're heading across the globe to Japan. The Bank of Japan is facing a truly historic rate hike decision.
And a massive dilemma for their economy.
Finally, we'll come back home to tackle that crucial November U.S. inflation data and look at the real inflationary costs of some of these tariff trade-offs. Okay, so let's jump right into the AI spending shakedown. We saw a really serious sell-off on Wall Street.
We did. The NASDAQ Composite, which is really our tech barometer,
Right.
it took the biggest hit, dropping 1.81%.
And virtually all of that pressure came from those big, highly visible AI-related names, didn't it?
It did, and the immediate trigger, according to reports from CNBC, was some trouble brewing at Oracle.
And this wasn't a revenue issue.
No, not at all. This was a financing confidence issue. Oracle's shares, they tumbled 5.4% after Blue Owl Capital reportedly decided to pull out of funding,
And this was a massive project.
a $10 billion data center project.
So the specific concern was Oracle's debt terms, is that correct?
Precisely. Blue Owl basically walked away because of concerns over how the debt for such a massive capital project was structured.
And that just pours fuel on the fire.
It immediately validated these earlier worries, which had been denied, that Oracle might have to delay some key data center projects.
The ones earmarked for major partners like OpenAI.
Right. And when investors see a financing giant balk at a $10 billion AI infrastructure deal, they immediately start to question the economics of the whole build-out.
And of course, that nervousness didn't just stay confined to Oracle.
Not at all. We saw the contagion hit the core hardware and chip sector.
Broadcom, NVIDIA.
Broadcom, NVIDIA, AMD. The market view becomes, okay, if the financing for the physical foundation, the data center, starts cracking.
Then the demand for the components that go inside them is also threatened.
Exactly.
And that worry went global fast. The CNBC coverage on Asia markets really highlighted this.
Yeah, the Asia-Pacific markets slid, led by Japan's Nikkei 225, which lost over 1%.
We have to talk specifically about SoftBank Group here. They got hammered.
They did. They fell as much as 7.25% before recovering a bit. And given their massive exposure to AI infrastructure,
The Stargate project with OpenAI.
right, all their investments, they were just a direct victim of that Oracle news.
But here's where that fragmentation you mentioned becomes so pronounced.
Yes. Almost at the same time, the market got a huge countersignal, which Reuters documented, that suggested the core demand story is still fundamentally sound.
You're talking about Micron technology.
I am. They just blew past expectations.
I mean, this is the definition of divergence right here. Wall Street is worried about the financing.
But the supply chain is worried about the availability of chips.
It's the perfect tension to analyze.
It is. Micron forecasts its second quarter adjusted profit at $8.42 per share. Analysts were estimating $4.78.
That's nearly double.
It's an explosion in optimism, and it's driven by one thing: soaring demand and critically tight supplies of high-bandwidth memory, or HBM chips.
Okay, so for our listener who might not live and breathe GPU specs, let's just clarify. What is HBM and why is it such a bottleneck?
Right. So HBM is essentially specialized, super fast, stacked RAM that sits right next to the GPU in an AI accelerator.
So it provides the bandwidth needed for these huge AI models.
The massive memory bandwidth, you need it to handle the vast data sets and billions of parameters for models like GPT-4. Standard memory, it just can't keep up.
And Micron is one of only 3 major suppliers.
One of only 3, along with SK Hynix and Samsung. So they have this extraordinary pricing power right now.
So even if Oracle delays building a data center because of debt issues, companies like Meta and Google still desperately need these HBM chips.
That's the structural demand story. Micron CEO Sanjay Mehrotra was unequivocal. He said memory markets are expected to remain tight well past 2026.
Oh.
He even noted they expect to meet only about 50 to 66% of demand from some of their key customers.
So this isn't just a cycle, it's a structural shortfall.
A huge one. And it's led Micron to dramatically increase its 2026 capital expenditure plans, all the way up to $20 billion. The money is flowing, but it's flowing to the guys who own the bottlenecks.
That sets the stage perfectly for global policy shifts, where the constraints aren't technical, they're institutional. We really need to focus sharply on Japan.
Yeah, the Bank of Japan is kicking off its 2-day policy meeting, and all the signs are pointing in one direction.
The rate hike.
LSEG data shows an 86.4% probability. They're expected to hike to 0.75% tomorrow.
Which would be the highest level for Japan's rate since 1995.
Since 1995, you're talking about a 3-decade-long policy paradigm being overturned.
But the analysis from CNBC highlights that the VOJ leadership is facing a really deep, fundamental dilemma here.
Oh, they're caught. They are caught between 2 conflicting forces. On one hand, they absolutely have to address inflation,
Which has been running hot for a long time.
it's been above their 2% target for 43 straight months. And they also desperately want to strengthen the yen.
Which has just been hammered, trading around 154, 157 to the dollar.
Right, which makes imports brutally expensive.
But the downside of hiking rates is terrifying for a country that has relied on ultra-low rates for so long.
Absolutely. You risk plunging an already weak economy deeper into trouble. We just saw GDP numbers showing the economy contracted more than initially thought in Q3.
So they're basically asking, can we fight inflation without triggering a recession?
That's the tightrope they have to walk.
So if we assume the hike to 0.75% is already priced in, what is the market actually listening for in the commentary from Governor Ueda?
It's all about the language around the future path. Investors are looking for clues on 2 key terms, the neutral rate and the terminal rate.
Okay, break those down.
The neutral rate is the theoretical rate that doesn't stimulate or constrict the economy. The BOJ pegs it broadly between 1% and 2.5%. Any hint that they see that number shifting higher would be huge.
And the terminal rate.
That's the peak. That's how high they'll go. Analysts at Bank of America think it could reach 1.5% by the end of 2027.
So if the BOJ signals they're willing to go higher or faster,
That would send bond yields soaring and massively strengthen the yen. It would impact global capital flows overnight.
and speaking of central banks, the BOJ isn't acting in a vacuum today. There's a policy blitz happening across Europe.
That's right. CNBC's European coverage highlighted it. The ECB, the Bank of England, the Riksbank, Norges Bank, they all have meetings concluding today.
And the direction of travel in the UK is the complete opposite of Japan.
Totally inverted. The Bank of England is widely expected to cut rates by 25 basis points.
Dropping their main rate to 3.75%.
And that's a direct response to softer UK inflation data. They seem to think they've broken the back of their price pressures.
But contrast that with Norway.
Yeah, Norway's Norges Bank decided to keep rates on hold at 4.0%. Their statement was explicit. A restrictive policy is still needed because inflation remains persistently high there.
It just underscores that there's no uniform global playbook right now.
It's all country-specific.
Which brings us across the pond to our own domestic inflation test. Today at 8:30 a.m. Eastern, we finally get the November Consumer Price Index report.
This is a massive data drop. Economists polled by Dow Jones, they're expecting both headline and core CPI to rise 3.1% year over year.
And here's where the context is so important for you, the listener. This is the first official CPI read since September. We completely missed the October data.
Because of the 43-day U.S. government shutdown.
Right. And that shutdown context, as sources like Yahoo Finance and CNBC emphasized, it makes this far from a clean report.
It does. Economists rely heavily on those month-over-month comparisons to gauge momentum.
To see if price pressures are accelerating or decelerating.
And since we don't have that October data point, there's a significant gap. It makes it really hard to gauge the short-term trend.
Some strategists even raise concerns about data bias, since collection only resumed partway through November.
Right. But despite all that, the psychological importance of that 3 handle is immense for the markets.
Absolutely. The difference between 3.1% and, say, 2.9% is huge for market sentiment.
It is. Jose Torres at Interactive Brokers highlighted that keeping inflation in the 2s could really strengthen expectations for Fed rate cuts in 2026.
And maybe pave the way for a year-end Santa Claus rally.
Whereas a higher reading just solidifies the view that inflation is proving stubbornly sticky.
Now let's connect this inflation worry directly to the real-world costs of trade policy. Bloomberg reported on President Trump's announcement of a warrior dividend.
A $1,776 one-time payment for 1.45 million U.S. service members.
Costing nearly $2.6 billion. And he explicitly linked the funding for this to revenue from his tariff regime.
Which instantly brings up that critical debate about who actually pays for tariffs.
Right. U.S. Customs collected over $200 billion in duties this year.
But economists, looking at the analysis in the CNBC sources, they consistently argue these are just hidden import taxes.
Paid by the importing company.
Which then, almost universally, passes those costs directly on to the U.S. consumer.
So they contribute to the very inflation we're tracking today.
Exactly. You have a political narrative of tariffs as revenue, but the financial reality for consumers and businesses is often just higher prices.
And the impact on small businesses? It's staggering.
Oh, it's severe. CNBC detailed how some companies are in real financial distress. We're seeing small businesses taking on crippling high-interest rate loans.
How high are we talking?
Sometimes between 20 and 30% interest.
That's predatory.
Just to cover these mandated tariff costs until they can sell their goods. The fear is financial disaster, plain and simple.
We heard from a toy company owner who said the tariffs are putting me out of business.
And potentially altering their retirement plans. The debt is so high that even if the Supreme Court later deems the tariffs illegal, these businesses could still be buried under all that interest.
It's a sharp trade-off between foreign policy tools and domestic economic health.
A very sharp one.
That tension is a perfect segue into hard commodities because they tell a very similar story of tight supply and soaring demand. And copper is the star here.
It absolutely is. Copper prices are near record highs, closing in on $12,000 a metric ton. New York futures are up 34% this year.
So why is Dr. Copper, as it's called, surging right now?
The reason, according to BHP CEO Mike Henry, is a structural deficit. The driver is this massive global push toward decarbonization and digitalization.
EVs, solar panels, data transmission.
It's essential for all of it. Demand is expected to rise by 70% by 2050.
And supply just can't keep up.
Exactly. Mining disruptions have consistently pushed the market into deficit, and the forecasts reflect this. UBS and Citi see copper trading between $12,000 and $13,000 per ton by the end of 2026.
And Citi even suggested a speculative high of $15,000.
They did, and part of that was due to speculation about U.S. hoarding.
Right, I remember that. Explain that briefly. Why would the U.S. hoard copper?
The thinking is that the U.S. might build strategic reserves, viewing copper as critical for national security, for green energy, for infrastructure.
So if the government starts stockpiling,
it removes a huge amount of supply from the open market, instantly tightens the deficit, and could push prices toward those very high targets.
Okay, let's move to another strategic material, rare earths. Reuters had a report from China on this.
Yes, China's Commerce Ministry is trying to streamline its export process for rare earths. They're granting new, easier general licenses to speed up shipments.
And suppliers to major companies like Ford Motor were among the first beneficiaries.
That's what was reported.
Yeah, connecting that back to our tech discussion, geopolitical tension over chips is just fueling China's race for self-sufficiency.
Oh, the investor enthusiasm for homegrown AI chip makers is incredible. The numbers are staggering.
We saw IPOs for companies like MetaX and MoreThread surge. What was it?
Nearly 700% for MetaX and over 400% for MoreThreads on their debuts.
Wow. And that's a direct reflection of China's need to find domestic alternatives to NVIDIA's best chips.
Which are heavily restricted by U.S. export curbs. So investors are willing to pay these massive premiums for companies that might not even have globally competitive tech yet.
Simply because they represent national strategic independence.
Precisely. They are betting on the long game. Huawei, with its Ascend series, Baidu's Kunlunxin, Alibaba, they're all investing heavily. It's a race to build a full independent ecosystem.
Okay, let's transition now to the evolving digital asset landscape. Bitcoin, after hitting that high above $126,000, has fallen almost 30%.
And it's struggling for support. What's driving this pressure, which Bloomberg called the silent exodus, is significant profit-taking.
From the long-term holders.
Exactly. The OGs. Blockchain data shows they're cashing out at some of the fastest rates we've seen in 5 years.
And how much volume are we talking about here?
A substantial amount. Over $300 billion worth of Bitcoin that had been dormant for more than a year has re-entered circulation in 2025.
That creates a slow bleed.
It does. ETF demand has faded, derivatives volumes are down, so the market is just less equipped to absorb this persistent selling.
And for these OGs who are sitting on huge returns.
When you're sitting on 1,000x or 10,000x returns, as Hassan Ahmed from Coinbase told Bloomberg, realizing profits at six-digit prices is just a natural event for the market.
Shifting to the infrastructure side, Coinbase is making some aggressive moves to become a true one-stop financial app.
This is a major strategic diversification for them. They're expanding into stock trading, streamlining futures, adding prediction markets. But the real vision,
articulated by CEO Brian Armstrong, is much bigger.
It's the complete tokenization of finance. He frames crypto not as a currency replacement, but as an upgrade cycle for the entire existing financial system.
The idea being that traditional finance is slow, expensive, and exclusive.
Exactly. And by bringing real-world assets onto the blockchain, tokenizing them, you can fix things like slow settlement times and limited access.
They've actually launched an institutional product for this.
They have. It's called Coinbase Tokenize. They plan to start with equities, but the goal is to bring every major asset class on-chain over time to, in their words, democratize access for people over the world.
So this deep dive has really shown us a global economy dealing with these sharp fragmentations.
For sure. The AI sector has collapse worries on one side with Oracle and explosive demand on the other with Micron.
Policymakers are racing between rate hikes in Japan and rate cuts in the UK.
And geopolitical competition is driving both inflationary tariffs in the U.S. and these self-sufficiency pushes in China's chip market. Every variable is moving differently.
It seems like what stands out is that across stocks, bonds, commodities, everything is responding to these fundamental supply bottlenecks and policy shocks.
That's the key takeaway, which leads to the big policy question, especially for the U.S. economy. Given that the Federal Reserve seems to be paying more attention to cracks in the labor market.
And maybe slightly less focused on past price pressures.
Right. So how much influence will today's potentially distorted November CPI reading truly have on the path of interest rate cuts in 2026? It really suggests the Fed's focus might be shifting from inflation to recession risk.
Which means we need to look beyond the headline number to the employment data. A perfect thought to chew on as we close out today's analysis. Thank you for joining us on this deep dive, and we'll see you all tomorrow morning with new headlines from major financial magazines.